Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra. As the financial year is coming to a close, there are so many investors looking for ways to minimize their tax liabilities for the financial year 2025. Now, in case you are a stock market investor and are looking to save some of the taxes, well, there is this one powerful strategy that you can definitely leverage, and that is tax loss harvesting. Now, this is an unusual benefit that most of the stock market investors get, but they seldom know and do about the same. Now, what is important to understand is when you invest in stock markets, there is something known as capital gains, that is the profits that you make of your investments. Now, on that profit you are liable to pay some tax. Of course, there is this every year 1.25 lakh rupees worth of profit that is tax free, but beyond that also the kind of profits that you make are liable for tax paying, and that is in two ways again. In case you book your profits before 1 year, then you are liable to pay short term capital gains tax. In case you book your profits after 1 year of holding your stock market equity portfolio or stocks, then you are liable to pay a long term capital gains tax. Now, what happens is there are so many investors facing losses because of the last 5 months of drubbing in the stock markets. But here's how you can actually put all of those losses to use by saving taxes, by booking your loss. And that's the strategy that we are going to be discussing today of tax loss harvesting. Now, tax loss harvesting is a smart technique that actually helps you offset some of the capital gains by realizing the capital losses, saving you money on taxes. So, let's dive right in and see how this really works. Tax loss harvesting involves selling of the investments and stocks that are currently at a loss to realize their losses. So, you book your losses. These losses can then be used to offset against any capital gains tax that you have made from the other investments, like in stocks, mutual funds, or even real estate as well. Now, here's how it works. Let's, for instance, understand that probably you made 1 lakh rupee of profit from one investment over and above the 1.25 lakhs that is a tax free gain that you've already booked. Now, over and above that, you actually had made 1 lakh rupee of profit from one investment. But on the other hand, you also have made 30,000 rupee of losses on another stock or another mutual fund or an ETF. Now, by selling the losing investment, you can offset the 30,000 rupee loss against the 1 lakh rupee profit, reducing your taxable gain to now 70,000 rupees instead of the full 1 lakh rupee. So, this helps you in reducing your tax liability. Had you not set off that 30,000 rupee of losses against 1 lakh rupee of profits, then you would have to pay taxes on the entire 1 lakh rupee of profits. And this way, you have reduced your tax liability because now you get to pay taxes only on the 70,000 rupee of the remaining remaining capital gains. Now, if you do not have enough gains, say this year, to offset against the losses, you have made more losses than gains, but there is a possibility that you can carry forward your capital losses for up to 8 years. So, for instance, for the next 8 years, you made a considerable loss this year. Keep that with you for the next 8 years. Keep setting it off every year for next 8 years against all the profits that you make. So, that is also possible. So, that allows you to offset future gains as well. Say next year you make about 70,000 rupee or more profit, then you can again book it against the losses that you have made. Now, before diving into tax loss and harvesting, some important things that you must definitely keep in mind. Remember that these losses cannot be offset against salary income. You cannot say that, in stock markets I have made losses, but my salary income is like a profit, so I set off my salary income against the income that I have made from equity markets and therefore reduce your taxable income. That cannot happen. So, remember, when you are investing in financial assets, they can only reduce your tax liability from capital gains, whichever asset classes give you or come under capital gains. Now, whether it is from equities or real estate or other capital assets. But to keep it simple, we will try and understand how can you just do it within the equity class right now. Say for instance, you have 10 stocks, 5 stocks are in profits and 5 stocks are in losses. So, you set off the gains against the losses, reduce your capital gains and therefore your tax liability on that. Now, the second derivative, gains cannot be offset against carried forward losses. That's also something that you should remember. In tax loss harvesting, there are two things. Again, like I said, short term capital gains and long term capital gains. Similarly, your short term capital losses, those equities that or those stocks that you have held less than 1 year and you made losses on that, that can be offset against both short term and long term capital gains. But when it actually comes to your long term capital losses, they can only be used to offset against long term capital gains. So, if you do not have enough long term gains to offset the long term losses, you then carry forward the excesses in the next future years. You have 8 years of a time frame there. Now, when it comes to short term capital gains, the gains on investments that are redeemed within 1 year. So, gains till, again there is this one more thing that you must remember, July is when there were changes that were made in the capital gains tax liability as well. So, all your short term capital gains till July 22nd of 2024 will be taxed at 15%, but all those gains that you have received post July of 22nd, that is after the last budget was posted, then your tax liability will be 20%. Similarly, for long term capital gains, gains on investments redeemed after a year, that is after redeeming 1.25 lakh rupees of tax free gain, above that 10% of a tax on gains were to be given as far as July 22nd of 2024 is concerned. But now this parameter or this tax liability has also gone up from 10% to 12.5%. So, all your long term capital gains tax made after July of 2024 will be taxed at 12.5% in case you book your long term capital gains tax. So, the tax liability has changed as per the budget that was presented in July of 2024. So, keep that in mind, because you will have to do some calculations and you will have to sit down with your CA to really figure out which are your long term capital gain stocks and which are your short term capital gain stocks, and wherever you are booking your gains, your tax liabilities will be different. So, keep an eye out on that. Finally, you need to be very, very careful about rebalancing your portfolio. While tax loss harvesting can definitely save you taxes, you don't want to sell investments prematurely and miss out on the potential market. This actually means that, for instance, you have made 8 stocks are in losses out of your 10 stocks in your portfolio. Now, there are some of the stocks that will show losses right now, but you have actually invested into them for long term, over 5 years, 10 years. So, why should you really book those losses, you may ask? Well, there is a scenario that you can probably do. You can actually book your losses right now and re-enter into these stocks, get back into this asset class, because your ultimate goal for these stocks was long term. Say for instance, you had a particular stock that you have kept for next 5 years in your portfolio. Today it might be showing a 20-30% loss. So, what you can do is book that 20-30% loss and after 1 or 2 days again re-enter into the same stock, so that you do not miss out on the potential market rebound. Probably the stock will end up making profits for you in the longer run. So, that is something that you have to speak to your financial advisor about. Exactly similarly, for mutual funds and for ETFs also, tax loss harvesting is very, very simple. You can actually sell a fund and then buy another in the same category. This also allows you to maintain exposure in the market while realizing the capital loss as well. So, when it comes to individual stocks, you have a bit of more flexibility. Sell a stock at a loss, either buy the shares of a competitor in the same industry or wait for at least 2 days before you again invest or repurchase the same stock too. So to sum it up, sell the underperforming investments, use those losses to offset the gains, carry forward any of the remaining losses for the next 8 years to set off against future gains that you might make and you may want to book, and make sure that you stay invested by maintaining the market exposure in all of your asset classes. I hope this has really given you enough clarity of how tax loss harvesting really works. This will definitely give you that clarity of how you should be going about it, but which are the key stocks that you should be identifying, or which are the mutual funds that you should be identifying for booking of losses, is something that your own financial experts can guide you better. Do write in to us on Business Today Television and in the comment section below in case there are any more queries that you still have on tax loss harvesting, that we can get a top market expert or an investing expert to guide you better as well. But definitely leave your feedback there, and we can continue to get you such fantastic market concepts which actually help you to save taxes even while you make losses. So losses are not all that bad when we talk about stock markets as well.
If you like the video, do like, comment, share and subscribe. If you like the video, do like, comment, share and subscribe.